All right, let's get straight into the numbers because if you have been watching the ticker tape this week, you know exactly why we are talking about this company today. It is currently Thursday, November 27, 2025. The U.S. markets are officially closed for the Thanksgiving holiday, so we are not seeing a live tick right this second. However, we have to talk about where we left off when the closing bell rang yesterday, Wednesday, because the action was absolutely significant. TMC, the metals company, Inc., ticker symbol TMC on the NASDAQ, closed yesterday's session at $5.83. That is a gain of roughly 7.3% in a single trading day. If you zoom out just a little bit, this stock has been on a tear that defies almost every conservative prediction made back in 2024. We are looking at a stock that has touched a 52-week high of $11.35 and is currently sitting on a year-to-date gain pushing toward the 400% mark. The market capitalization has swelled to approximately $2.41 billion. Now, when you see a penny stock, or what used to be a penny stock, explode like this, the immediate expectation is that it's a pump and dump. The common belief, the expectation, if you will, is that this is just another meme stock rally fueled by retail traders on Reddit and high-risk speculators chasing a quick buck. You expect to hear that the company is failing, that the environmentalists have shut them down, and that this price action is just noise before the inevitable crash. That is the expectation. But here is the reality, and it is significantly more complex and frankly more aggressive than most people realize. The reality is that TMC is no longer just a mining play. It has effectively mutated into a geopolitical proxy war. We are not just seeing retail hype here. We are seeing a repricing of the stock based on the realization that the United States government, specifically under the current administration following the 2025 inauguration, is seemingly done waiting for international permission to secure critical battery metals. The catalyst driving this price isn't just about rocks on the seafloor. It is about the United States effectively signaling it might bypass the slow-moving International Seabed Authority, the ISA, and issue permits under domestic U.S. law. That is the massive shift that has taken this from a speculative science project to a national security asset. Let's break down exactly what happened in the last few trading sessions leading up to this Thanksgiving break. The volume yesterday was massive. Over 16 million shares changed hands, which is double its average daily volume of around 8 million. When you see volume double on an up day leading into a holiday weekend, that is not usually retail traders getting bored. That is institutional positioning. It tells us that major players wanted exposure before the market closed for the holiday, likely anticipating news or further momentum coming out of the weekend. The action we are seeing, bouncing off a low of $5.47 and pushing toward that $6 resistance, is a direct response to the Trump trade narrative that has dominated the materials sector throughout 2025. Since January, the executive focus has been crystal clear: secure the supply chain. We have seen executive orders back in April that explicitly stated the goal to advance U.S. leadership in seabed mineral development. For a company like TMC, which was previously languishing in regulatory purgatory, this was the green light the market had been terrified would never come. Now, pause for a second. I want you to think about how you are currently positioned in this sector. Are you holding this, or are you watching from the sidelines thinking it's too late? Comment below how many shares of TMC you currently hold and what your average entry price is. I am genuinely curious to see if we have long-term holders from the $1 days, or if most of you entered during this 2025 rally. Let's get deeper into the mechanics of this move. Why is the stock up 400% this year? It's not because they suddenly started selling billions of dollars of nickel yesterday. The company is still pre-revenue in the traditional sense. They are still burning cash, reporting a net loss of over $184 million in the third quarter alone. If you looked at the income statement in isolation, you would run for the hills. But the market is forward-looking, and right now the market is pricing in a regulatory breakout. The specific development that has everyone watching, and what likely drove the volume yesterday, is the company's strategy to apply for a mining permit under the U.S. Deep Seabed Hard Mineral Resources Act. For years, the narrative was that TMC had to wait for the UN-backed ISA to finalize the mining code. That process has been agonizingly slow, filled with bureaucratic delays and intense lobbying from environmentalists. But by pivoting to apply under U.S. domestic law, TMC is effectively saying we are going to operate under the protection and regulation of the United States government. That aligns perfectly with the current administration's stance on reducing reliance on Chinese processing. This is where the smart friend advice comes in. You need to understand that when you buy TMC right now, you're not buying a mining company. You are buying a political outcome. You're betting that the U.S. Department of Defense and the Department of Energy are going to muscle this through despite international outcry. If you are sitting there looking at your Schwab Intelligent Portfolios or checking your Fidelity Wealth Management dashboard, you probably won't see TMC listed in the safe conservative growth category. It's not there. This is a binary event stock. If the U.S. grants the permit, that $2.41 billion market cap could look cheap. If the international courts block it or the administration pivots, the floor falls out. Let's talk about the institutional side, because this is often where the retail investor gets left behind. If you are trading on Robinhood stock trading apps or using SoFi investing platforms, you see the price move, but you don't always see who is moving it. We have seen data indicating that funds like First Manhattan Co. have held significant positions. When you see institutions staying in a trade despite a company losing $184 million in a quarter, it means their risk models are factoring in something big. They're not betting on quarterly earnings. They're betting on asset strategic value. They know that the Clarion-Clipperton Zone, where TMC has its claims, contains enough nickel and cobalt to electrify the entire U.S. passenger fleet multiple times. In a world where NVIDIA stock and Tesla stock dominate the headlines for their AI and EV prowess, we often forget the physical reality of those industries. You cannot build a Tesla battery or a NVIDIA data center power supply without copper, nickel, and cobalt. The terrestrial supply of these metals is getting harder to mine, lower grade, and is largely controlled by foreign entities that the U.S. is currently in a trade war with. This is why TMC has outperformed the S&P 500 massively this year. It is the only pure-play asset that offers a made in America, or at least controlled by America, solution to the raw material crunch. Now, I want to address the skeptics, because that is healthy. If you are using interactive brokers trading platforms to short this stock, you have a valid thesis too. The environmental pushback is not a joke. Greenpeace and the Deep Sea Conservation Coalition have been incredibly effective at mobilizing public opinion. They argue that we do not know enough about the deep sea ecosystem to start vacuuming up the ocean floor. There is a real risk of reputational damage to potential customers. For example, if Apple stock takes a hit because they refuse to buy deep-sea metals due to consumer pressure, TMC loses a massive potential market. The reality we talked about earlier isn't just about permits. It's about the social license to operate. Can TMC actually sell this metal if big tech is too scared to buy it? However, the counter-argument, and the one the market seems to be favoring in late 2025, is that the alternative is worse. Terrestrial mining involves deforestation, child labor in the Congo, and massive tailings dams that can collapse. Deep-sea mining, specifically regarding nodules, involves no digging. The nodules sit on top of the sediment. You vacuum them up, separate the mud, and send them to the surface. It is asset-light compared to building a mine in the Andes. This lesser of two evils argument is gaining traction in Washington, even if it hasn't fully convinced the public yet. Let's look at the financials again, but with a different lens. The company had about $3